All
Yeah.
streets are the same when it comes to financial markets. Ladies and gentlemen, welcome to the stage, the lovely Dave Nadig. Put your hands together.
Hi, hands together.
Welcome.
Dave, welcome.
What's everyone drinking today?
Just a nice
little
glass of
rosé.
wine. Mike, do you want to give the compliance spiel?
Sure. Well, I want to hear what I want to hear the details of Dave's.
Oh, you're right. Yeah, you guys have
beverage.
fancy
This is an Angel's Envy Manhattan.
Whoa. So what's the story on Angel's Envy Manhattans?
It's just a really good bourbon.
Oh, I love that. So I too am drinking a bourbon sour, a whiskey sour bourbon sour. This is handmade. That's the froth of an egg white that I put in there myself. Squeeze
Good
the
for
lemon.
you.
That's why I haven't been able to
Oh,
reach
God.
you on Slack in the last hour. Now it's all coming together.
Yes, it's all precisely right. And it is still, you know what? I wanted to bring my my cocktail game up because I knew Nadig was going to come on with something special. He was going to bring the championship belt.
Eggs and
Mhm.
alcohol.
Yeah.
Never been
are
a
you
Where are you
kidding
going to
me?
get your protein?
Have you ever tried it?
Go sour.
I
Whiskey
have.
is
I have
the
tried
best.
This is
Right.
how you can drink endlessly without getting drunk. You
Right,
get your
'cause it's got
protein
the
in every
protein.
shot. Of course.
Yeah.
True story.
All drinks have raw eggs in them.
Yeah.
Another Canadian specialty is the Caesar, right? Which comes with it's clamato sauce. In the U.S., it's not very big, but it just comes with the clamato juice. But the key is to actually get clams in a can and drop them in at the bottom.
You're
with a
just
long,
making crap up
with-
now.
Swear to God, this is the perfect beach cocktail. So
And then you get a toe and you
it's
cut the toe
vodka,
off. And you put
it's the
that-
vodka,
this
the
is-
clam, the clamato juice, some salt, some pepper, some Worcester sauce, a little bit of veggie, whatever pickled veggie you want on top. But you put the clams at the bottom with the long spoon, and then you drink while you eat.
Yep.
It's absolutely delicious.
Typically,
And
when
you do it for
drink those
8
for
hours
breakfast.
at a time. Well, yeah, it's breakfast of champions. Then you add an egg for breakfast.
Exactly.
Yeah.
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 That's breakfast. And
What did we
brunch.
drink yesterday, Mike? Like I didn't.
Oh,
I didn't get
yeah.
the
We
name,
had the
especially at the end.
Australian. We had the Australian. We did the Shiraz of Australia. We had a flight of some Australian Shirazes, and then we had the battle of a California Syrah versus a French Petit Syrah. So it was quite the day. It was all the Syrahs, all of
But
them.
one, I'm guessing the petite
Taste
Syrah
Syrah.
one because it's more interesting and spicy.
I liked it better, and it was French, and the French just do wine better than everyone else.
Ooh, that's great for it.
We just lost 50% of our live participants.
So speaking of participants, all participants should be notified that whilst the advice with respect to wine and fine liquors is absolutely within the scope of this conversation, all investment advice should be achieved and attained from a professional in your community area, licensed area, etc. This is for entertainment purposes only, and Dave is very entertaining as well as are the rest of us. So don't take any of this as investment advice. Okay.
You know,
So that's
every week
stated.
you do that little spiel, and I keep waiting you to say, "Seek the advice of a professional, unlike anybody here."
Yes,
Like you
not
never
on this call.
deliver the punchline.
That goes without saying, don't you think?
I'm trying not to say
We
yes.
go on to prove that every episode.
Right.
This is really just going to be an episode of Critical Role.
Yeah. So
Exactly.
we should definitely do that.
I got my dice.
Corey's asking, why does Dave look so much better than you guys?
Clean living, man. Clean living.
Yeah.
living.
Corona living.
Yeah.
Corona
It's
living.
better cocktails, more creative cocktails.
So you were saying, you were telling me offline, what type of exercise were you and your wife doing? What did you guys decide to do?
Yeah, so before people hopped on, so we've had the other side of the COVID experience. I know a bunch of people have put on a little bit of weight and are now trying to get out from underneath before the winter hits here in New England. We had the opposite, which was this stuff hit and I got off the road. And all of a sudden I used to travel 60 to 70% of the time. I mean, it was very rare I had 5 days in a row without going somewhere. And so once I was locked in for a while, my wife and I both just started jumping in. We started with around a P90X3, which is, the old Tony
so good.
Horton
It's one of my
video
favorites.
series.
Love that.
My
Cheese
favorite.
City, just pure cheddar.
Yeah.
And
you
we had a
love
good
it.
run at that. And then we both decided we want to do a lot more lifting. So we jumped into a lifting regimen that we've been doing ever since. And we're down 4 days a week on lifting and 2 days a week of something outside, big hikes, cardio. I'm also training for March for the Fallen, like I know some other folks, which is looking at the calendar, 2.5 weeks? Yeah, I'm screwed.
2 weeks in a day.
Totally screwed.
2 weeks in a day.
I see Rodrigo looking a little sheepish here. I'm feeling definitely like we're not equipped for that this year at all.
We're going for a walk.
We're doing a virtual walk, right?
Yeah,
we're doing a
we're
Dungeons and Dragons walk.
I'm going to get up in the morning and put my shoes on and start walking. I just don't know what's going to happen after that.
Precisely.
So Dave, you travel a lot. Why don't you give, for those listeners who haven't heard about your background, what were you doing when you were traveling? What's your expertise? What are you known for in the industry?
Yeah, sure. So I'm largely called like the ETF guy. I started in the ETF business back in '93, which if you're keeping track is before there were ETFs. I was part of a team at what was then Wells Fargo Nico Investment Advisors in San Francisco, working on what would be ETFs 2 through 14, which were called the WEBs or the World Equity Benchmark Shares, which I think those things finally started trading in 95, might have been early 96. But I was on sort of the build-up team for that. I was a child, to be clear. It's not like I invented them or anything dumb like that. I was a 20-something-year-old getting coffee for people who knew more than I did. But I was sort of trapped in that index structured products, ETFs business, which was a huge part of what Wells Fargo Nico was trying to build then. And then was on the team that became BGI, Barclays Global Investors, when we sold the business to Barclays, and then was there for about 18 months, sort of doing the transition, mostly shutting down all of the retail fund businesses in Asia and Australia. And then came eventually, long story short, was an active fund manager during the dot-com boom. That didn't work out very well.
That's a great story.
Back to the ETF space.
Can you tell that story or no?
I can, but we'll get there in a minute. But anyway, long story short, I ended up back in the ETF business in the early 2000s and was at etf.com for about a decade. Ended up being the CEO at etf.com. And then fairly recently, just in January, left etf.com to join Etf Trends and Etf Database, which were sort of competitive sites. Trends being the more content-oriented one, DB being the more data and research-oriented one. But I focus on product structure. I focus on quant financing as it impacts actual advisors and investors, sort of not necessarily at the depth you guys go, because you guys will go real darn deep. But I'm mostly a poser when the math gets too hard. So once you put an integral in the equation, I tag.
That's where Mike comes alive.
Anything scribbly. Is it in crayon? I'm definitely there then.
Exactly. So there's a story to tell then about your mutual fund days.
I was both the best and worst active manager in the world, depending on when you want to start the measurement points. So we started so I ran a fund with partners, obviously called Open Fund. The company was called Meta Markets, and we started in 97, 98, something like that. And we were a new economy tech fund. I mean, it's cringy to talk about it all now. And we basically bought momentum, flipped IPOs, and that worked incredibly well until it all worked incredibly badly. So we wrote it out, like we had 150% up year and a down 94% year. Like it was just straight up.
That's like a break even.
Yeah, it was basically, it was like a mountain climbing expedition. And then, we were starting to go bankrupt when the market crashed. And by the time 9/11 happened, that was all she wrote. And we just shut the thing down. But it was fun. But it made me even more convinced I should be a quant, not an active manager.
So say more about quant financing. You're mostly focused on quant financing of ETFs. Or say more about that.
So I come to ETFs from a quant background, right? So when I started in this business, I was drinking the Kool-Aid of indexing of the late 80s, early 90s, which was really everything in the institutional space at that point. And so, at Wells Fargo Nico, our clients were the Federal Employee Retirement System and, CalPERS and, the Harvard Endowment and all of these huge pools of money that had migrated towards passive really in the late 80s and early 90s. And so from there, it was all about, well, now what's the next thing? What are you adding? Because honestly, the margins were crap back then and they're still crap now, right? I mean, we ran the Federal Employee Retirement System in 1993 for, I think, 2 basis points for the large cap equity exposure.
93?
Yeah, 93, 94. It was definitely sub 5. I mean, it was very, very thin, but it was, I don't know, tens of billions of dollars mandate.
Sure. I just didn't know it went that low even back then.
It did. It did. Now, interestingly, one of the games back then, which everybody now realizes, but didn't then, was the ability to lend, right? That was where all the money was. The inefficiencies in the second lending market were just phenomenal. And that sort of has carried on into BlackRock's business today. I mean, BGI was bought by BlackRock. iShares became the brand in the late 90s. But, under the hood there, the secret to their success has often been a very, very good sec lending program. I was
going to ask you, actually, just on your ETF side, are we at the point where we're seeing negative TERs yet because of basically the fees are zero?
We had a couple, but they haven't lasted, right? So we had so the SoFi funds are still out; those are at zero, right? And that's part of the shtick there, right? Is there some money to be picked up off sec lending? There was a rebating fund that was rebating $50,000 a year past zero to the fund. That one got closed down. At that point, I think people legitimately look at that and think it's a gimmick. One of the things that's happened is the margins in sec lending for most stocks have collapsed because there's just more information. It's a much more open market. There are services like data explorers that will actually tell you how much you should be paying for a borrow, those kinds of things. So they're cornered
supply, right? Because Vanguard and BlackRock basically lend out all of the securities in their
Vanguard much less. So Vanguard's so different firms have very different approaches to that. BlackRock's been a very aggressive securities lender, meaning they're going to try to have as much of their portfolio out at a time as they can. They run that program internally, and then they split some of the top line revenue, most of the top line revenue, back to the funds. And then they basically try to earn a profit on the part of the revenue that they're collecting, but they have to staff a desk. So I think it's a very equitable relationship, and I think they're very, very good at it. Other firms, I think Vanguard in particular, and this could be wrong now, but historically they've used lending agents, right? So they hire somebody else to run a sec lending program, and then they share 100% of the profit back to the fund, which is different, right? Profit versus revenue. There's been a lot of debate over the years about which one's fairer. I think in general, BlackRock investors have done better on their deal with BlackRock, which is it's probably 75-25 now. For a long time, it was 50-50. Then it became, 2/3, 1/3. It's definitely going in favor of investors. But, that for a long time in index management, the norm was a 50-50 split, and most, if not a lot of the revenue at least was being made on the sec lending side of the desk, not on asset management, not on, pushing the button on the spreadsheet to revalue your S&P 500.
Right. So for ETF Trends, you cover sort of the stuff that's at the forefront or new and novel in the ETF space. So what are some of the things you're looking at right now?
So this year has been a really interesting year, and not just for the normal reasons we would expect, not just from COVID and election years and global politics and all that jazz. We've had a couple big changes. So this is the first real year of what we call the Etf Rule, which has just basically made it a lot easier for people to show up and launch ETFs for a lot less money. That has not led to a huge raft of new ETFs. Granted, there are 2,500 of them, so we probably have enough. But the other thing that happened was we saw the passage or the approval of a whole bunch of so-called active, non-transparent structures, or semi-transparent, or we could just give up and just call them all active strategies, because that's really what they are. And that's been a really interesting part of the market. We've had some really successful launches. American Century has a couple $100 million in their strategies now. T. Rowe just launched, basically their 4 best asset managers in the T. Rowe enterprise as ETFs. Those seem to be doing pretty well. And, for a nerd like me, that was super interesting, because there was a lot of question about, will the structure work? And is one better than the other? And will this one, and the end result is, cut to the chase, they're all working. They're all fine. They're all perfectly well designed. And market makers are more than happy to show up and keep these things trading, until something hits the fan. And so far, everything's worked perfectly. So the structure stuff has gone away.
Just so I can understand what that rule has done. So you're basically not forced to divulge your positions at all times. how long can you keep, like, you have to report what, 1/4 in
Yes.
arrears?
So basically so two different things. So the active non-transparent structures, each one of them is different. So the first out of the gate was from a company called Presidian, which is owned by Legg Mason. T. Rowe Price is doing a different structure. NYSE has their own strategy. So there's a bunch of different ways of doing it. But at the end of the day, what you're doing is saying, we're only going to disclose the way a regular mutual fund discloses, which is quarterly, usually with a 15-day lag. And that's sort of the standard, frankly, for most of the industry. And most of the industry is just fine with that. Like most active managers, even in SMAs, aren't sending a daily portfolio position report to every SMA client. They're just giving you an update monthly or quarterly, and that's fine. We're all fine with that. That's what these structures do, is they basically say, we're going to this sort of standardized quarterly disclosure model. They could do it sooner if they wanted to, but quarterly is what most people are settling on, versus ETFs, normal ETFs, fully transparent ETFs, where you're basically showing your portfolio every morning at 8 o'clock, whether you want to or not, because that's how you built that structure. So it lets an active manager effectively blind their portfolio the same way they would if they were running a traditional mutual fund.
And the concern from a market making perspective was that the spreads were going to be much wider, and because they don't have as much transparency. How has that worked out?
It's worked out. So every one of these solutions has their own trick for how they solve that problem. Because if I'm supposed to arbitrage a basket in the morning to be able to do a creation, I got to know what's in the basket, because I got to be able to run a hedge, right? Nobody wants to take a giant unhedged risk. So in a traditional ETF, you know precisely what you have to deliver at the end of the day, and the manager knows precisely what he's going to get. So there's no friction. So that all works really well. And that's why ETFs function. All of these non-transparent structures have some way of signaling to the market making community what fair value is. So that could be a verified true portfolio value disseminated every second, like a truly verified indicative value that's just a constant data stream, which once you have that, being nerds, you would know, you can then build a model that's going to map that pretty tightly. You already know basically what's going to be in the portfolio because you know what it started with 30 days ago or 40 days ago. So that makes it pretty easy to run a pretty tight hedge, because we're not talking about crazy strategies. These are all US equity strategies. So it's
right. I was going to think it would get much more difficult as you get more esoteric.
Yeah,
sure.
and like emerging markets and derivatives, and it would get really tough. But the stuff that's come out is pretty, I wouldn't say it's vanilla. Some of it's very high conviction, high active share stuff, right, but it's still playing out a US equity beta. So it's pretty easy to figure out a half-day hedge to get to the end of the day. And sometimes there's proxy portfolios that they publish that are guaranteed to be 95% of the market cap of the actual portfolio. So they all have different nuances, but they get to the same place, which is they give the market makers enough confidence to be able to go in and arbitrage out any big price discrepancies. And so far it's worked.
Is there any fungibility side to that where, so usually, if you're big enough, you can say, I'll take the underlying. Are these ETFs preventing that so that they don't deliver the underlying to, I guess, the maker?
Yeah,
or whoever might be large enough?
So again, there are a bunch of different models here. In the proxy model, you get delivery of the proxy. That's what you're going to get handed, right? Mm-hmm. So it may only be 95% of what's in the actual growth equity fund, but you're getting the 95 out of 100 growth names that you expect to get. So you can just choose to do that. And the same thing on the way in, you have to deliver those 95 out of 100 names to be able to get the shares of the ETF. So that works fine. What you don't get to do is what's happened in some fixed income products historically where, hey, you know what? This underlying is really hard to buy, so I'm not going to bother. I'm going to buy the ETF and then present the basket and get the underlying handed to me. So that's happened in like junk bonds, junk munis. Big institutional players will use ETFs effectively as a washing machine to grab some of that stuff out that's a little bit tough to get clean. Yeah. But you can't do that in these non-transparent structures at all.
So some of these models, I guess, are if you're provided the NAV and then you need to build. So the market maker's got to build a model. So it's some kind of asset pricing model. Presumably, it's going to be based on some kind of estimated betas to industry sectors or factors or just Kaplan beta. I think we were chatting before, right? You read Corey Hofstein's new paper?
Oh, super great. Yeah. If anybody hasn't read it yet, Corey's on it.
The liquidity cascade, that one?
Shameless plug.
Yeah. Yeah. Right. Exactly. But no, but he did talk about this as a contributing factor to the increasing fragility of market structure, right? Where you've got market makers who are trying to model their exposures for hedging purposes using some sort of asset pricing model, and typically that's levered to market beta, and so changes in market beta change what they need to hold in their model and vice versa, and it introduces more of this sort of
there's a lot of reflexivity.
Yeah.
There's a ton. I mean, it's not just ETFs, right? Like our whole market structure right now has multiple reflexivity inflection points. Can you even say that?
Absolutely, you can.
Reflexivity is the correct way.
What that paper does, which is it sort of quite brilliantly goes through and says, where are all of these unexpected relationships? And some of them are very strong and identifiably correct and provably true, like the pro-cyclical rebalancing of leverage or something like that. Those are like, that's just math. That's how that works. There's no way around it. There's no dodge. There's no better product. And some of it is a little bit harder. And you guys have talked about this with several of your guests here. Things like, what are you doing to the price discovery mechanism as X% of the market becomes quote unquote passive? Those also have these sort of reflexivity qualities to them. They're much more harder to prove. The transmission mechanisms are sometimes specious, but they're still true in the sense that, yes, if 99.9% of the market was indexed, we would have no price discovery, et cetera. Like they hold up when reduced to their logical absurdities, but we live in the real world, which is a lot messier. Right?
So what are the frictions in the real world that in your opinion derail or diminish the veracity of some of these stronger claims about the impact of passive investing, like the ones made by, for example, Mike Green? I don't want to single him out, but just sort of like that general.
No, that was a great conversation. I love that conversation. Right. And I'm not going to sit here and try to refute his, 50x multiple math or any of that stuff. But some of the like the complexities that get lost in there. The first one is just this assumption that passive is passive, and that all passive is created equal. And that when we say something like, "Ooh, the market's 15% passive now," what does that mean? That's such a big umbrella, because inside that 50% passive, you have an enormous number of people making systematic value bets and an enormous number of people simultaneously making momentum and growth bets in passive vehicles. But nobody would try to tell you they're ambivalent about which one happens for price discovery in those underlying stocks, right?
This is such a nomenclature challenge, right? I mean, Corey and I were chatting throughout the day about this, because you get this pushback on, well, indexing is passive or not, or, so much of, I think, what Mike Green is saying and what Corey was asserting is predicated on a definition of passive, which is market cap weighting, right? And if you're deviating from cap weighting, then you're active. Well, and we don't need to have a discussion about nomenclature, but if we sort of just say, so actually, I'll throw it back to you. So there's been claims that about 45 to 50% of the market is now passive investing. Does that include non-market cap weighted index investing in that number? Or do you have better or more granular numbers that you would?
Well, so first of all, nobody has any of those numbers, because the only thing we can track is public product. So, and the vast majority of index money is not visible. It is not something that you're going to see when you go to your Bloomberg screen and pull up.
BlackRock came out with a report a couple of years ago where they also surveyed.
They tried
something like $6 trillion worth of global institutions, and they're trying to triangulate, right? But
right.
Anyway,
so look, it's a big number. It's something less than 50% and more than 10. That we're in that range.
95% range.
That's what you got.
The problem is that would be a problem if what all that money in was either like ACWI or VT or something like that, but it's not, right? Yeah, there's a big chunk of it that's in the S&P 500. Okay, well, let's start with that. The S&P 500 is the most actively managed index in the world. There's a committee that decides what goes in and out of it. We just saw that. Tesla, while it is 1% of the US market, is not allowed into the S&P 500. So okay, that for reasons based on something.
So
other
I
than-
agree.
Wait. Can I just?
It's a bit of a
I didn't hear this. Did they excluded it because of a technicality or a discretion?
They excluded it for reasons they have not chosen to disclose.
But
Like,
either way, like it's pretty close to. I agree with you. Technically, it is an active index. There's a committee, and they select, and sometimes there's oddities.
But you just had
app,
a stock lose 15% of its value because a bunch of people in a boardroom made one decision. That is not passive investing.
But it's also not typical, right? Like that's an outlier event. But
no. That is not an outlier event. That's
okay,
the norm. Like, look at what happened when the Qs just decided to spontaneously rebuild the NASDAQ 100 index because they didn't want to have to kick Apple out. These big old name brand indexes that we talk about, like the NASDAQ 100 and the S&P 500 and the Dow, God forbid, they're not passive and they're not actually particularly useful target vehicles for investors. If the passive number we're talking about, whether it's 10 or 50%, was the Russell 3, then we'd have a much bigger problem. But underneath this umbrella of passive are people doing low vol smart beta and hedge funds doing sector rotation strategies. I mean, if you look at flows, yeah, big cheap beta does tend to dominate flows, but it's not the same big cheap beta, right? If everybody decides to sell their SPY and buy IWM, which is the small cap ETF, well, okay, that's price discovery. We just did a whole bunch of selling of large cap in favor of small cap, which in fact is what we saw in a bunch of August, right? So,
but if they were to sell SPY and buy the Russell 3000 or a VTI or something like that, and so it's a total market index, you're still 95% of the cap weight of that index, of the weighting of that index is still going to be the same.
Right, but that's not what we actually. So when people talk about indexes, that's not what daily flows look like, right? So to Mike's point in his previous, when you had him on, he's talking about sort of this incremental flow that would happen if everybody sold Contrafund and bought SPY. The problem is they're not going to buy SPY. Some of them are going to buy, Principal's mega cap smart beta fund, and some of them are going to buy the Qs and therefore load up on Tesla. And some of them are going to buy SPY and skip Tesla entirely. And you add all those decisions together every single day, and it is not a monolithic move into cap weighting. That's just not
that's
monolithic. The monolithic discussion often comes around this idea of forced retirement plans. You're working, a portion goes into your retirement plan. That retirement plan goes to these passive vehicles, and I don't know as much as you do. Cap weight. That's what I was going to ask.
But I think we should change our nomenclature.
But again,
retirement accounts seem to me to be very cap weighted oriented. They're not getting fancy with factors. They're not getting fancy with anything else, and they're not timing between IWM and the SPY. They're really just buying an endless amount of that very passive ETF. And I don't know what that number is, but if it continues to grow the way it does.
But the irony is that defined contribution space is one of the last places that active fund managers are still pulling in assets. Like if you remove the defined contribution market, the US mutual fund market would be a fraction of the US ETF market. Like the defined contribution assets dominate the active flows. So ironically, the opposite is true, which is that endless bid on the bottom of the market, while it rolls up to cap weighting, because by definition, all active managers together equal the market, the way it's being implemented is, some Dodge and Cox fund that's still charging $1.50. Like that's where those funds still get assets.
At the margin, are we seeing more money flow? Like your typical defined contribution fund, they're not there are very few funds that are migrating from passive index based
for sure
default options to active default options. There are much larger number that are moving the other way, and a new entrant in
this
the market.
Is a state of disequilibrium.
Yeah, so it's at the margin. So I will certainly agree with you, or at least I'll concede to you that there is still a very large fraction, and one of the larger fractions across all the different investment cohorts in active funds in the defined contribution space. At the margin, you are still seeing a continuous flow of funds toward the passive space. And away from the traditional active space and towards cap weighting. No.
Yeah. So I'm not trying to argue that active is in the middle of some massive comeback and we all missed the memo. That's not the point. I'm not trying to make that point at all. I'm simply saying that when we're starting to talk about things like structural impacts on price discovery, this is a big, complicated, hairy market. And so I get nervous anytime anybody tries to tell me, well, because of cap weighting, the market is destroyed. Because I look at flows every single day, and on any given day, it's just as likely for me to say, flows into SPY and its ilk are down 10 billion, and flows into momentum tech stocks are up 30. Like, that's not an unusual day in this year. But try to tell me why that means that we don't have any price discovery going on.
Well, hold on a second. So we have your 1993 example for you replicating indices at 2 basis points,
right?
30 years ago. So we know, like, institutions have a pretty dominant place, and there's a whole bunch of assets that are just parked.
Yes,
sort of market cap. They're not even part of this discussion, and so this is where and I'm not sure that it really matters in the sense of it is the madness of markets to some extent. You're in a disequilibrium state where you are going from active to passive every day, generally, not every day, generally
at
speaking,
the margin on average.
At the margin,
right.
where the prices are made.
With you 100%.
So this is the challenge, right? The active manager has a set of stocks. They're sold every day, and then they're placed with their cash into the index, generally speaking. So not on whole, but at the margin, that disequilibrium is where we sit at the moment. And that is the thing that can cause distortions until such time. So if, the whole argument that, a market cap could be 85% of the 85% of the market, but 15% would preserve price discovery because that 15% would go and find the price. In equilibrium, agree.
But isn't
on
that
the way? We're gonna have large distortions based on herding, human behavior, all of these other issues.
So I think we would all agree that the S&P 500 is a decent proxy for passive investing in the United States, right? Certainly the most used, most tracked, most invested large equity
argue
in the United States.
Yeah.
So I don't want to lose an argument. So okay.
But if we start with that, then explain to me how in this time when we would expect even more money to be running from their underperforming active managers that are charging too much into the S&P 500, why are we seeing a higher concentration spread in performance than we've ever seen in my career, where you've got 10 stocks in the S&P 500 responsible for 40-something% of the returns, and the others.
If I'm a return chaser,
right,
I'm going to chase those 10 stocks.
Right, but my point is, if all the money was just going to the S&P 500, you would actually expect the top and bottom stocks to be quite tight. And that's not actually what we've seen. Like, I haven't run the money.
No, I don't think so. That one little point of disequilibrium that causes the 10 stocks to begin their roll down the snowball hill creates more and more self-reinforcing price discovery, which says, no, I should own more of Microsoft, Facebook.
But that's an active management decision. So if all the money's passive,
true, it is. That's fair. So it is a herding / self-reinforcing cycle. I'll be quiet.
Like the first papers I read on this, like in the late 90s, early 2000s, about how indexing was going to destroy the world, or go read the, indexing is worse than Marxism argument from Bernstein, right? You go read that paper. The core of the argument is price discovery is going to and is collapsing, and therefore the mean performance dispersion between the best and worst stocks in the S&P 500 will continue to collapse until there's no longer a meaningful difference from the best stock and the worst stock in the index. The actual math says the exact opposite has happened. We've had just massive divergence between.
I don't think that's what I don't know that that's what that implies, right? So one of the things that fell out of a lot of these conversations about cap weighted indexing is the fact that so imagine, and I'm just throwing numbers out there, but imagine that Apple has 5% of the cap weight of the index. I'm not sure what they have, but let's just say they have 5% of the cap weight of the index. Do they have and that it's 50 times larger in terms of its proportional weight in the index than the 10th largest stock. Does Apple also have 50 times the daily dollar liquidity as the 10th largest stock? And if they don't, but at the marginal dollar, they need,
It's pretty
need
close.
to go into that stock. But
Volume,
is it?
Trading volume on a dollar basis tracks market. I mean, I haven't run the study lately, but I've never run that study and not had it be a pretty damn high correlation between.
But even if it's slightly off, even if it tails off at like, it's 80% or 90% or whatever, then you're going to have a disparity where you've got dollars that are going to flow into the market. They're going to hit the offer. There's going to be at the margin fewer shares, dollar weighted basis, fewer shares on the offer, and all things equal, there's going to be not enough supply in the largest stocks to meet the demand, because there just isn't the same proportional level of supply as there is required for that share of market capitalization.
I actually think there's something much more interesting going on here. So it's not that I disagree with any of this, right? Like, clearly, if you reduce this argument to its absurd level, sure, indexing destroys the universe.
That's Butler's favorite approach to all arguments.
Yeah. Right.
I want to hear the more interesting one.
Everything's got to be ridiculous. But so I always come back to these two things. It's like, we can have this interesting debate about this, and you can't tell this is one of my favorite topics ever. But like, we can have this debate. There's a bit of so what? Like, are we going to like literally ask Congress to pass a law banning passive investing, and exactly how would you implement that? I mean, like, literally, there's a little bit of so what.
No, but I don't think there's no one on this. Well, we might complain internally about this dynamic, but that's not really the point. The point is, if this dynamic is true, then what should we do, or how should investors position? Right.
Right. And I think so. I'm glad we got there. So I think that's interesting, but I think actually there's a much bigger story behind this, which is that because of the way media has started to influence investing, right? Started with Reg FD, and it's just gotten worse and worse, or better and better, depending on your perspective, right? Where everybody knows everything all the time. What that means is larger companies are always going to have more focus, whether that's research, data, news, whatever, and smaller companies are going to find it harder and harder to break through. And this is just another version of these inequalities in the economy we're seeing over and over and over again.
So differential attention.
Yeah. So the reason we talk about FANG stocks is not because it rhymes and it's cute. It's because you can go through almost anybody's model: ESG, smart beta, tech, trend following, thematic, and you'll find the same 50 stocks in almost all of them. Now, some of them get splintered off, like, the energy stocks don't end up in the ESG stuff. But boy, it's incestuous, and that stuff overlaps. And that's not because it's wrong. It's because the way we think about investing is now permeated by this sort of information frequency culture. And so we created this bizarre thing where stock 504 in the cap spectrum doesn't have a pathway to get the same attention, except doing it the old-fashioned hard way of running a better business, earning more money, and having their fundamentals show up on somebody's screen, right?
So this information I just want to understand, we're talking about 500 stocks in the market. The ones with smaller market cap have less resources in order to get the attention that they need. You're talking about attention on who's coming to their quarterly calls, who's writing a report on them. Okay, yeah. I just wanted to separate actual research being disseminated to these allocators that you mentioned versus just simple zeitgeist. It's in the Twitter sphere, it's in the zeitgeist. Everybody in the planet's reading or hearing more about these larger stocks, and therefore at the margin, they're getting more of a bid than the other lower cap stocks.
Right.
Yep. Okay.
Well, and to loop this back to some of where Corey was headed in his paper, and back to the point of like, well, okay, if we assume that some version of this is true about the markets, what does it mean for how we invest, how we tell our clients to invest? Let's focus on that, because we're not going to pass laws banning indexing, right? I mean, that's ridiculous. So what does it mean? I think it means that we are in this period of heightened volatility. And that's part of why I love the fact people are trying to talk about this in terms of convexity, because what it means is the steady state market, whatever we're thinking it is actually the most fragile state of the market not the sort of lowest entropy state, right? It's actually the highest entropy state. It's the place you're most likely to get tipped off. And so if you accept that, then what that means is low volatility would be the time to just lever the hell out of both your puts and your calls, right? You just create that smile and accept the fact that if the market goes like this, I'm going to lose 2%, and I'm fine with that because that's not the equilibrium state. And so that's part of why I love Corey's stuff so much. Is part of what recently, oh God, I'm going to get the name of the funds wrong. There were 3 ETFs launched this week that I was just like nodding my head about. Corey will type it in chat. I think it's SPY-C for convexity. And it's, two old industry veterans who basically are building products to basically do this and say, look, the equilibrium state is not steady state markets anymore. Let's assume that's the disequilibrium state and put all of our extra energy in making sure we make money on the tails, which I think is a really interesting.
It's been interesting this last week how NASDAQ lost 10% faster than its history. Like it was like 4 days of massive losses.
Simplified
by, of course.
Yeah. Well, whole separate conversation about volatility equaling speed, which, I think is a really interesting way of thinking about it. Which somebody on your show has said recently, that idea that we haven't actually increased volatility, all we've done is shorten time. That feels much truer to me than anything. There was a great NPR story 10 years ago on auditory, making the sound of trading audible. And when you do that, you can literally hear how the market's changed, which I think is really interesting.
Oh, that's neat. Yeah, I got to look into that. So, yeah.
Sorry, I'm rambling now.
Can I say ticker symbols here in the podcast so that we?
As long as they're not mine.
I didn't give the advice. I'm just going to say some stuff.
You can say whatever you want, but not ours.
SPYC, SPUC, and SPD, whatever they are.
Right. So it's SPY convexity, SPY up convexity, SPY down convexity, right? Ones.
So what are the underlying mechanics? Are you familiar with them yet? Or you haven't had a chance to dig in?
I believe what it is just getting beta exposure to start with. I don't know whether they're buying IVV or whether they're doing that by buying all the stocks. My guess is they just launched, they're buying IVV or VU. And then they're just using options to basically profit from being wrong on the downside and profit from being wrong on the upside, right? So you're effectively taking the dividend yield to the S&P 500, which is 2% headed to zero, and then using that to fund options on either side.
And you're just buying more straddles as Vega compresses because you can spend the same dollar amount but buy more units. Yeah. As Vega compresses and vice versa, and try to preserve that.
Further proof the only class any MBA should take is options and just move on. Because if you can not because you should all be trading options, because once you understand all your Greeks, everything else just falls into place.
Yeah, you're able to price everything else more appropriately. Yeah. You did mention ESG. Now, I mean, this seems like
don't get me started.
A cavalcade of
Mike. I would have thought you were Mr. ESG.
Oh yeah, I'm also very politically correct.
Yeah, I just failed a while ago.
He had to leave 2 progressive countries so that he could speak behind.
I love ESG. I just would like to know who's E, who's S, and who's G.
Well, I totally agree with you there.
Like to espouse, and once we identify that, then of course you can do it. I think Notre Dame has done a wonderful job, and Notre Dame in their investment endowment has espoused an E, an S, and a G that are very congruent with a certain religious Catholicism, which makes perfect sense. I understand that wonderfully.
As a failed Catholic.
Yeah.
As a lapsed Catholic.
Aren't they all? Aren't we all? It's all built on forgiveness. Anyway, the point is, how do you until you can get to that group that you identify with? This is really hard because you need to identify very specifically who you would like to identify with in those ESs and Gs, and so that's where it falls. It falls down for me a little bit. It's not that it's not a good thing. That's just my philosophical issue.
You're totally right. The problem with ESG is it's packaged products, right? Packaged products are the worst way to implement ESG, except for every other way that we've had pretty recently, right? Because, literally in the ETF space, we have the Catholic Values Fund and the LGBT Fund, both classified as socially responsible investing. Obviously, those two portfolio managers would not agree when they got into the same room.
Yes.
But like as an ETF nerd, I basically have to say, yeah, these are both values-based investment strategies.
Values-based investing, exactly. It should
Right.
be VBI.
We should start a values-based ETF company and have like choose your own values.
Your values.
Like
What you're
That
talking
would be your IPS.
Are you
Your IPS would
Muslim?
be values. Are you a monk?
Are you a monk? Do you believe in women's rights, even male rights?
Are you a monk probably gets narrow real tight.
I don't know. I'm into bald male rights. Are you with me, Dave, or what?
Yeah,
You-
like
I'm
the
coming-
fund for me, the head polishing fund.
I think you'll get low AUM on the bald, rich white man category, brother. I don't know if you're gonna. That'll sink the whole.
But but this is the problem of ESG. It has been a big year for ESG. It's been, double the flows we've had in any year in ESG ETFs. If you actually layer in under mutual funds, it's even more, right? So it's definitely not a fad anymore. There's hundreds of billions of dollars showing up in these strategies. Again, led by institutions. That's where all this started. Because like you said, people like Notre Dame can articulate a mandate very clearly and have the assets to be able to say, you manager, go run this strategy for me. That's where ESG ends up. I think ESG is what cracks direct indexing open for the average investor. Certainly firms like Parametric and Optimal, they've built whole businesses on this already, whether they called it for ESG reasons or not. But a lot of advisors I've talked to, they actually are approaching this from a two-pronged perspective. The two biggest problems they have, some guy walks in who's a Google executive, but wants to be passively invested. And now you've got to figure out how to get him into a bunch of index funds that don't have Google in it. Good luck with that. And chances are he's probably not going to short Google to get it out of his portfolio, because when that shows up on the PR, that's real bad. So solving that problem, what do? You get in the S&P 500 -1. Very easy to do in a direct indexing platform. The other thing it lets him do is say, and I don't want to own tobacco stocks, right? And then he can just say, okay, it's S&P 500 -3. That's super easy. And there are a lot of platforms building there. Canvas from O'Shaughnessy Asset Management is probably the one that I think is getting the most attention or traction with a certain class of, billion plus FinTwit advisor. But I think that is the future, and it becomes the future really quickly once folks like Schwab bolt that into their fractional share program. And now all of a sudden everybody rolls their own index.
And I think there's a
category. Are these advisors can plug into these platforms and choose categories for their clients? So 500 minus type of.
So there are quite a few platforms that do this now. O'Shaughnessy's been pretty out there on financial Twitter about it, because that's sort of where they are. But like Just Capital has been doing this, Ethic Invest, Open Invest. There's quite a few of these platforms sprouting up right now.
It's very interesting in this world of protecting your 1% to become the ethical advisor, where you're paying them to make sure that you go to heaven rather than hell. Maybe
this is the point.
That's brilliant. Like that's just another angle, another marketing angle.
Also, the interesting thing about this angle, and this is where like who's E, who's S, and who's G. If you can actually customize that to the point where you can make it bespoke for the individual, you now truly have an ESG, and you have, I think, an extra layer of defense against behavioral vulnerability.
Yep.
Because if I'm part of a tribe, that even gives that extra layer. But if I've articulated a level of values, now I'm not beholden to performance vis-a-vis an index of ruthless capitalists. What I am is I'm a thoughtful investor who's decided on how I might invest ethically, and am willing to suffer the slings and arrows of whatever performance cometh, because I will only invest in an ethical manner. So you get this extra layer of, I think, behavioral attenuation if you can actually deliver an ESG that is totally customized to someone's value set. I think it grows in power exponentially if you can attach it to a group, obviously, because then you have a group of people who are supporting one another in whatever the performance would be, outperformance, underperformance, and whatnot. But I
think it's fantastic, because what it means is that there's an entire new cohort of investors who are non-profit seeking. So they're willing losers from a profit seeking perspective, which means that, hey, maybe factor investing might experience a renaissance. There may be some nickels lying around for passive indexes or active indexes.
I thought I was in the role of cynic, but okay.
No, it's like I'm gonna blow a.
I've been encroaching on that for years.
I'm gonna pop your bubble on that, because what we've seen recently is that probably since the Volkswagen blow up, most of the data being used to drive ESG portfolios, and I'm not saying this means it's ESG, I'm saying most of the data being sold to people implementing ESG strategies, which means it's coming from usually Sustainalytics or MSCI. If you actually use that data, it turns out to be, whether it's useful as a social tool or not, it turns out to be a pretty interesting risk management tool. And that's really where this has started to raise it. Like the average ESG fund has beaten the crap out of the average non-ESG fund so far this year. Now, the reason's fairly straightforward.
A bit of a self-fulfilling prophecy, I think. Right?
No, it's because the current crisis we're in has crushed energy, transportation,
how are the airlines doing,
and manufacturing, right?
Are we getting back to cascading effects?
Yeah.
Are you pro cascading effects again? Look, so one of the interesting discussions between it's really what you're saying is the ethical versus the alpha, right? And so I was at an alternative conference recently where Kaysa Depot was saying, look, we're going to become much more prone to look at the ethical nature of how you invest in the funds. But there's a big, we have constituents, and we have our goal is to provide a certain level of return in alpha. And so we have to put these two things together, this idea of excess returns and ethical investing, and ensure that we're meeting our ultimate objective, which is to provide real money to our constituents at the end of the year. And so what's more important than that to our constituents, and what's actually the goal of what investing is about? It's a tough debate, and I would lean towards make the money, right?
Well, it depends.
You capitalist pig.
Depends on your mandate, right? Like, so I'm an Episcopalian, and am very tangentially touching some of the folks that do the Episcopal endowment management and all that stuff, and it has a bunch of ESG stuff in their investment mandate. They, low carbon, all that kind of stuff, which sounds like, because I grew up in the 80s, that sounds like I'm giving something up. But increasingly, what we're seeing is that doing something like using the input of how exposed somebody is to weather events, that's actually risk management. That's whether you care about the environment or not, you can't argue the frequency of high impact storms from an economic standpoint has gone up. So that is a data set. You can argue about why. I'm not here to have a political argument. I'm just saying I have a bunch of data that suggests.
Shouldn't the risk premia associated with those companies that have that?
They should be high. They should earn a higher return.
They will, because they're being priced down, right? So if you assume that they're managing those risks well, and that there's not a chance they're going to have a dead year because they were exposed to a bunch of weather events and all of their refineries went offline, then sure, if they manage that well, they should earn a huge excess return. But currently they're priced as if those things basically never happen, right? So very few companies are correctly priced for their exposure to weather. I would argue some ags are pretty well, like soybeans respond pretty damn well to weather forecasts, right? Because
so I'll grant you some of this, Dave,
looking at that,
but I do think it's a bit of a slippery slope, right? Because it's just really easy to build an index that expresses biases that you can position as, for example, anti-carbon companies have performed better than carbon-heavy companies over the last 10 years or over the last 15 years, but really it's just because they've been energy light and energy is underperformed. It's really easy to create narratives to support a values argument and sell that.
You don't have to do any of that. My point is, you can using divorce yourself. You can be an automaton and approach this from a big data perspective. I have 4,000 inputs. I'm going to mine that data to see what's predictive of standard deviation in my stock price, right? Totally standard big data thing to do. If you chose to do that and ignored intentionally everything around board diversity, everything around governance standards, everything around regulatory play ball, everything around bribery statutes, everything around energy. It's like if you chose to ignore every one of those data sets, which is now publicly available and 10 years ago was not available at all, you would be in violation of your fiduciary duty. Like these are important data sets about risk parameters that you have to at least test.
No, I absolutely agree with that. We've got new data sources that provide completely different dimensions of risk on individual companies. They should absolutely be factored in, but I don't think that's quite where ESG goes, right? ESG is not factoring them in with a profit incentive. They're factoring them in order to be able to express a set of values or create a narrative around expressing a set of values to appeal to.
It's an ESG bug, not a feature, right? It just that's the side effect of what. It's not what they cared about. It's not what they wanted to do. But all of a sudden, alpha generators have access to this database that ethical managers are not using it for that purpose. You talked about standard deviation around certain features. That's not what they're doing. They're using it to become a better ESG fund for their constituents. But it's been a byproduct of that has been that everybody else can benefit from better information.
It's been a bonanza for people who want to data mine a strong an index with strong historical performance that also they can spin a great values story around, as cynic would say. You know, like I could certainly.
But again, does it matter whether you're a cynic or not if the end result is you've generated better risk-adjusted performance for your client? And what I'm saying is there's an increasingly large body of evidence that whether or not you give a shit about anything, pardon my French, if you are simply trying to generate a lower standard deviation, higher alpha after, that ESG is a pretty damn good way to do that. Like when I started doing ETF analysis 10 years ago, I was building this data set for ETF.com. We put in a measure of risk-adjusted alpha because it was like, oh, okay. And literally no smart beta fund, no actively managed bond fund, which is all we had then. None of them generated out of the 1,200 funds we were looking at in 2010. Not one of them generated risk-adjusted alpha over 3 years or longer. Not that surprising. It's a tough thing to do. You look now, almost every ESG fund does on a 3-year basis.
So don't they load on quality and low vol?
Well, that's not what they intend to do. What they intend to do is look at things like board diversity and carbon impact, et cetera, et cetera. Those tend to be whether they're important or whether they're proxies for other things being managed. Like diversity in a workforce and board diversity, I think, are one of those things that are canaries in a coal mine. And I tend to be getting political, I tend to be pretty left of center. That's like fine, whatever. And I know that's not the same with everybody else, but regardless of that, dismiss all of that. Having a reported highly diverse board implies certain things about how you're managing the company. And it's the implication that's actually important. The having one other voice on the board, I don't actually believe is the thing that made your company perform better. But the fact that you made a point of doing that probably implies you're listening to your employees more than you would be otherwise. And that listening turns out to be a risk management factor. That would be my argument.
You got the result team speechless.
I think it's an interesting.
I think that's fine. At the end of the day, if we go to 2008 when oil and agricultural are ripping, you can go do your analysis then and tell me how that works for you.
You can't.
The
data did not exist.
The same. The thought of having some ethics would exist. And if you had done that, you are a loser. Amazon doesn't do anything. Nobody does anything. Agrium, Potash, Exxon is the largest company in the freaking world. All of the data that you would have mined to support the case in that slightly different time frame would have invalidated this if the idea is that we're going to provide excess returns.
There's a reason why ESG is coming about right now, and it's not just the political climate. It's also because the quality low vol companies that typically are included in ESG indices have outperformed for 10 years.
Yes.
And if in a different market
is it correlation? or is it causality?
Yeah.
I mean, it's true. I remember when when Mike was talking about the commodity crisis, my Wall Street moment was being in the muck in Toronto during that massive commodity boom. And there was a fund that whose benchmark was the Canadian S&P TSX 60. And it was a long-only equity fund that charged 2 and 20. And it was crushing that benchmark. And why it was crushing that benchmark is because it was 100% energy and mining and potash.
Yeah,
and
sure.
Was that Rohit's fund?
It was not a little bit of alpha. It was just massive. But when you compared it against, well, my whole shtick was, okay, cool, they're beating the S&P, but compared against the commodity index, and they're underperforming, right? They're still underperforming a passive index, which you would enjoy. But at the time, if you're an ESG fund, or let's say somebody creates an anti-ESG fund during the 2000 to 2010 period, they would have crushed the ESG funds in your model, right? It's a lot of correlation. We got, and the causality. You convinced me on the causality. I'd love for that to be true. In fact, I did a thesis in college on that same thing: quality management, quality board. See how the profitability was of the organization, and there was a correlation there. We saw that. So I'm kind of with you. But I also see the other side.
Let's go back to this sort of people hurting and the convexity issues here. Regardless of whether any of us is right in our argument on either side of this, and the people in chat who are violently disagreeing with us, doesn't actually matter. I'm totally fine if everybody thinks I'm a moron. The problem is flows are suggesting lots of other people think this way too. So whether you buy my argument or not, let's again bring it back to what are we doing for our clients? What are we doing as investors? If going forward, more and more people are going to be including these values-based decisions in their investing, what should you do as an investor? Now, if you believe this is a short-term flash in the pan that will disappear in 16 months, great. Take the counter on it. We have $30 trillion in assets being handed down from people who are average age 75 to who are average age 45. That group, average age 45, also called millennials, you look at the surveys on that, they are off the charts on their desire and expressed interest in values-based investing. And that's a question we've been asking since the 70s, and no generation has ever polled anything like this one. Now, skeptically, you can say, yeah, until they lose money, blah, blah, blah. However, it doesn't mean that they handed this money over the outside view. But
I don't know that that's the skeptical view. I think that's the outside view. Show me some people that want to lose money. But at the end of the day,
but the point is, they're not.
The millennials might.
If they are the market, then this will come.
The millennials might, except that they think that Tesla, that Elon Musk is a god that's going to save humanity, and therefore their ethics go all to him.
Out the window.
No, but they're making money. They haven't lost it yet.
Exactly. That's
what I mean. Like,
but it's like this is my point about things like Tesla. It doesn't like whether I like Elon Musk or not has no bearing on anybody in the universe. It's just a question of whether or not I believe other people are going to like him so much that they bid
you're up in my Keynesian beauty contest now. Like I am 100% with you. I have one algorithm we need to solve. How do you make one good drink and then not have to just drink straight bourbon after because your cocktail is done? Give me that algorithm.
Somewhere near you got to get dinner.
You don't mind? Can you get me that algorithm of how I get a second drink?
My wine was done 10 minutes into this, so I've been thirsty for.
I know, me too. But that's why I brought the bottle of bourbon. I thought I got to have a fallback.
Exactly.
For what it's worth, just to cap ESG, because bourbon's actually an interesting case in point, right? I'm not one of these people that believe that like alcohol stocks are going to go down because so many people don't want to drink booze. Like I'm a realist. Like, I live in the real world, right? So the idea of like sin stocks and non-sin stocks, like if that's how you want to invest, that's great. That's awesome. But I'm only trying to figure out what do I think the mass of people are going to do. And I genuinely believe that there is a mass of people who are going to care about social issues, governance, and global warming.
Marijuana stocks.
And whether or not you believe in that or not doesn't matter. If more buyers of stock believe that.
What do you think about marijuana stocks in the U.S.?
There are no marijuana stocks in the U.S.
I'm talking about the future.
Not the real ones. No, Canadian small caps for the win. Think local.
Think local.
Didn't Meb launch that? Didn't Meb launch a token?
Yeah, CBD stuff. Yeah.
Oh, it's CBD.
Yeah,
No, there
CBD.
is now, I don't know much about it. There is now an ETF in the US that claims to only invest in US listed legal cannabis adjacent companies because there is no actual publicly listed cannabis
pharmaceutical companies. It's the new
a
pharmaceutical.
lot of dancing to make your index work.
Yeah.
Is that
cannabis
That's
adjacent? I've never heard that before, but I like it.
Yeah.
Hilarious.
I agree with you, by the way, that it is like that whole ethical theme. I just can't go anywhere without hearing about it. And
I hear from advisors everything.
But what's happened is it used to be like a year ago. It was okay, great, let's invest in your stuff. Looking back, oh, by the way, do you invest in any of that sin stuff? Oh God, no. We use futures contracts, so it's got nothing to do with it. Oh, okay, great. Now it's becoming part of like questionnaires. And it's just going to get more and more stringent from there.
We have a great
doubt that it just goes bananas from here.
There's a great question in chat, which I want to actually address, which says the question becomes how long investors or corporations will tolerate underperformance in the future when it happens versus politically correct images or beliefs.
Preach.
I think it's a false premise. It doesn't.
What?
Well, because I actually don't think they're let's just take one small issue. Let's just take board diversity. And let's narrow it super down. Do you have a woman on your board? If that became the rubric by which people allocated capital, then companies who put a woman on their board will do better as a class because they'll get more capital. It's a self-fulfilling
that's true with the margin, but there are much larger forces at play. The point I think we were making earlier, right, is this is all well and good until there's a fundamental shift in the macro dynamics. So if we go into an inflationary environment and commodity producers are again driving index gains, then typically commodity producers are not known for their diverse boards and wanting to promote women and minorities, but they are going to completely dominate. And there will be a reversal where a lot of these sort of tech-oriented companies which thrive in deflationary growth environments like we're currently in will move towards the bottom of the heap. You'll get 5 or 10 years of underperformance.
That's not how ESG money is being allocated. By the way, ESG money is being allocated based on minimum variance. So if you look at the things that have actually pulled in money, it's things like S&P, which is the S&P 500 sector balanced, kicking out, I don't remember what it is, 25% of the company.
It allows for the fact that in a gold and precious metals index, there are just less women that are employed in the mining industry and then have the opportunity to bubble up through to the directorships. And thus, anyone who has more, if you have a woman or more, you will have more representation in that index. Is that sort of what
that's
you're saying?
my point, exactly. Right? And that's, you look at S&P and E5, which State Street just launched, and their whole shtick is we're just starting with the S&P 500. We all agreed those companies should be there, and we're going to sector balance them. So if energy is 10% this year, you're getting 10% energy. But the 10% energy you're going to get is going to be the one that scores highest on carbon mitigation, on how they're handling.
So now we're back to, that's fine, but now we've compromised our values, right? That's fine. But
no,
are
it's
they
fine.
values or are they?
But all these things
like
that a lot better, man. They're all
a lot better.
I like it better too, but if I had values, I wouldn't.
But you don't.
I don't have values, so I just don't care.
We've long
if I had values, I would be like, I don't want that.
Right. Well, we'll make a special Mike index next.
Well, that's a whole different ballgame.
Did you profit? Remember CalPERS back in the late 90s? When was it that they kicked out Philip Morris tobacco stocks, and then and it just blew the earnings yield on tobacco stocks to the moon, and anyone who was able to take the opposite side of that was just made out like
retail investors who probably, still hold, in my retail career back then, those investors still hold that Philip Morris, and they've done very well by violating their values.
Well, and it gets to the point of
other people's values.
Yeah. Yes. Well, but I think this does get to the point of how much are people willing to vary from the market to express these opinions? And the money has all shown up in strategies that vary very little from the market, right? They improve their ESG scores by 20%. They go from a 50 to a 70. It's not that they all become saints. It's just that they incrementally do a little bit better because, again, the math is showing that actually reduces your portfolio volatility and doesn't impact your returns.
If I'm a gold stock CEO,
Can we control for sector?
No, we don't. That was a different type of value, but that scores high. The point is that if I am a competitor within the gold space and gold is killing it, the first thing I'm going to do is make sure I tick off the first 10 boxes of whatever the most ESG Venn diagram is.
Or whatever was influencing capital. Like my stock ticker needs to start with a C. Okay, I changed the name of my company. You do what you need to do to make that change.
Yep. That's fine. I think that's a much more enlightened view from the perspective of asset owners, because the portfolio manager gets to claim the optics of ESG without really compromising any of the profit-seeking values that they are actually accountable for as a fiduciary.
One of our portfolio managers at Resolve just, Ani, why don't you put up her comment there? I 100% agree. If you see it there, yeah. Hashtag women in finance. There we are.
Yeah. So this is a really
my daughter huge on our ESG on Resolve. Guys, allocators, listen up.
But I mean, my daughter had the opportunity to go into finance, but she was not particularly enamored with the male-dominated sort of sphere that it is.
You mean like the 4 white guys on this call?
That's a thing of the past. All that's going to change. Like,
think of the past.
No.
I feel like I'm in the present.
No, legacy stuff. Nothing changes in a year. Look, I'm a Peruvian in one of these things. I'm like, now that I'm where I am, I'm getting a little darker. I'm starting to differentiate a little bit from you guys, the Latin American. And so you're seeing progress already.
Yeah.
Yes. Rodrigo Hector Gordillo Pizarro in one of these.
Yeah.
In 10 years, it'll be like it'll get to the right.
We shouldn't underestimate what is sort of the inching towards better behavior across the board. Like that's I'm not arguing against
present
that.
Company excluded.
But I will also say like that. Yes, last night's discussion with one of our traders, portfolio managers internally who ran a prop desk in Chicago was enlightening. Right? He's just he's got a singular focus on making profit. And he said something last night that just kind of surprised me, because he'd never, when he talked about his traders, he just talked about them just broadly. But he had more women in his team than anybody else in his organization, and it was because he doesn't care. Like he looked for the merit. Can you pull through? Can you actually deliver on what I've taught you? Can you make money? And if you can, you're in. And then when he looked around, he had more women than anybody else. And I asked him, like, what do you think that was about? Or were you just better at choosing merit-based people? And he's like, no, there's clearly a bias in the industry there. And this idea that, there's not women in finance because it's not an area of expertise, like your daughter not liking finance, that's an anecdote. I think that once you break those barriers down, and JP is a perfect example of a guy that would be able to do that, you can see a lot more representation of women in finance.
I can't wait to tell my daughter, Mackenzie, that you referred to her as an anecdote and her feelings are not meaningful in the greater construct of the discussion.
I will say this from the ETF side.
God, that we're on an island.
From the ETF side, we've been trying to put together some sort of ETF industry group since about 1999. There is only one, and it is women in ETFs. We've never been able to get the industry to agree on anything except for women in ETFs, which I would argue is one of the powerhouse forces in the ETF industry. Like, if that group gets together and decides a thing, it probably happens.
Right.
And so that is a narrow thing about the ETF industry. It's one of the things that I loved about the ETF industry. It's one of the more diverse parts of finance, which means it's like not even close to representational of the actual population. But compared to, say, trading floors in New York, yeah, sure. And I think that's true of quant finance in general, right? I mean, I think I think if you looked at the number of CFAs who are minted every year, I'll bet you it's got a better demographic split than the broad finance industry, for sure.
Definitely. Yep.
I remember my daughter, again, I'll harken back, we're going through school, and
Her name is Anecdote, is that right?
Her name is Anecdote.
Yeah.
And anyway, I won't mention her by name because I haven't approved this conversation for broad distribution. So if she hears it, I will have lots to pay. But there's a program called Women in Finance, and she was recruited and applied into that in her first and second year, got accepted. And it's quite a comprehensive program. It is a wonderful program. But the whole point was that women make decisions to opt out of finance prior to their masters. And so what they wanted to do is provide women the opportunity to operate in finance, come into finance prior to the graduation of their undergrad, because they need to get them there and influence women and encourage them to get into this industry before they graduate and go into their masters. It has to happen before that. And so a great program. Shout out to Women in Finance. Really amazing program. Still wasn't able to convince my daughter to come into finance, but that's another story, I suppose.
Rush those math tutors too. I remember they were like rotating in and out of your house on a weekly basis.
Of course. Yeah. All to graduate in art history and economics. So there you go.
She's gone on to engage in the noble pursuit of law.
Yes.
And, so I guess
I can feel the family lawsuit coming already.
All right, gents. I do have to get going. You guys are free to continue to chat, but is there any major topic?
I think that's great.
Yeah.
Good. That's good.
I appreciate your time, Dave. That was a wonderful journey through a labyrinth of finance.
Hopefully it wasn't just all me just rambling about random crap.
No, we were all rambling about random crap.
It was great. I like seeing the other side of the cascading effects, Mike Green type of argument, which is
well. Go. Everybody should go download Corey Hofstein's paper, Newfound Research.
Totally agree.
Absolutely. Yep.
We probably should get someone from Women on ETFs on this too.
I will make a few suggestions for sure.
That would be awesome. Thank you.
Great idea.
All right, man.
All right. Thank you. Have a great weekend, guys.
All right.
Yeah. Enjoy. Cheers.